think that's the lobby open. We'll give people a couple of minutes to join and I'll start introducing the webinar. First up, thank you very much to the panelists for joining us this afternoon and giving up your time to come and talk to us about decrypting digital assets. So hello, welcome to everyone. Thank you for joining in the audience as well. I hope you're looking forward to digging a little deeper into digital assets with our panel today. We're going to be looking at digital assets through the lens of the current market environment, the opportunities of the technology, and what it means for both incumbent and emerging organizations in the space. We're going to be making a clear distinction between distributed ledger technologies, digital assets, and cryptocurrencies, some of the asset classes that are enabled by the tech. I would just add at this point, there will be time for Q&A at the end. We'll come to that with about 15 minutes to go, so at about 1:45. We would encourage everyone to use the Q&A functionality in Teams. It's just in that top drawer at the top of your screen to submit any questions that you have. We'll be stacking those up and asking them at the end. The chat is open if anyone wants to exchange views as we go through the webinar. So, by way of introduction, Valentia Partners is a management consultancy that's been supporting financial services businesses with their transformation agendas since 2006. We've seen technologies come and go and supported banks, payments firms, investment managers, and more recently, early stage fintechs in harnessing emergent technologies and building them into their businesses. The backdrop to today's webinar is a particularly interesting one. We've seen greater standardization of regulation across both the crypto and digital asset spaces in Europe, and we've seen continued reluctance to engage in that agenda in the USA. We're curious about how that's going to affect the ability of financial services organizations to engage in the space, whether it's going to enable or prevent deeper engagement from incumbents. We've also seen some major scandals in the crypto space, and we've seen attitudes swinging back and forth in terms of the safety and security of crypto and the businesses associated with it. We're seeing some breakthrough products, including the recent Bitcoin ETF that's been launched in the USA, that seem to signal a growing acceptance of digital assets in the mainstream. And bearing in mind that all of this is playing out against a global backdrop that has been affected by the COVID-19 pandemic and severe inflationary pressure in many global markets. Digital assets are one of those technologies that really does have the power to fundamentally change the financial services industry. Keeping track of the story has been a major project for, I think, all of us on the panel, but certainly us at Valentia Partners over the last couple of years. And at VP, we've been constantly asking two questions. The first is, how will this technology change the industry? And the second is, where are the opportunities for financial services businesses to harness their power to drive their strategic goals? And we'll explore both of those today. So to help us unpack these questions and more, we've got a great panel on board today. We've got John Cronin, who's CEO of Zodia Custody, Sean Mullins, who is SVP of Digital Assets at Northern Trust, Ian O'Mara, who's partner at Matheson LLP, and our own Carl Houlihan, who is a partner at Valentia Partners and head of our fintech practice. Welcome to all of them. Panelists, could I ask you to introduce yourselves, and in so doing, would you mind telling us what your interest in digital assets is and what your organization's involvement is in the space? John, can I ask you to kick us off?
Sure, thanks, James. Hi, everybody. My name is John Cronin. I'm the CEO of Zodia Custody Europe. Zodia Custody is a digital asset custodian. Our parent is Standard Chartered. We're majority owned by Standard Chartered Bank, and minority owned by Northern Trust and SBI, a Japanese bank. So we provide custody of digital assets for institutions. From my journey in crypto, I fell into a rabbit hole around 2016. I was in management consultancy, got some interesting projects at the time that unfortunately couldn't do, but yeah, saw some really interesting stuff, and then fell into a rabbit hole on it, set up a digital asset platform that I sold in 2020, and then got approached to set up the European operation of Zodia Custody, and this is how I ended up in digital.
Thanks, John. It's great to have you on. Ian?
Hi, lovely to meet everyone today. So I'm Ian O'Mara. I'm a partner in Matheson, which is Ireland's largest corporate law firm. I'm a partner in the Financial Institutions Group. which means I'm a financial services regulatory lawyer. My practice is kind of in the payments, fintech, e-money and digital asset space. So I've had a number of firms in this sector get licensed in Ireland, either as e-money institutions to handle, say, fiat aspects of their digital assets business. And increasingly in the last number of years, I've had a number of clients get registered as, say, virtual asset service providers with the Central Bank of Ireland. So I'm very interested in the space because it's ever changing. We've also got the new legal framework called MICA coming down the track as well, which is taking up a lot of my time in my practice at the moment. And yeah, just very interested to chat about digital assets and discuss the trends that we're seeing in the market right now.
Thanks, Ian. Sean?
Yeah, thanks, James, and thanks for having me on. Hello, everyone. It's Sean Mullins, working at Northern Trust in the Digital Assets Financial Markets Group. So from a personal perspective, yeah, very much like most people on this call, I think it's just a subject of interest. I've been working in the innovation group, or in the innovation space at NT for around about 6 years now. So I've seen many hype curves, many subjects come and go of interest, but sort of the use of DLT, blockchain, digital assets have been around for a while and been on our radar for some time now. Personally, I have dabbled with crypto, as you can imagine, unsuccessfully, hence why I'm sitting here and not in a boat in the Caribbean or something along them lines. Yeah, purely always fascinated in change, always fascinated in what the future looks like. And luckily, I'm in the privileged position where a big chunk of that is my job. From Northern Trust perspective, as John touched on there, with regards to crypto, we're a strategic investor in Zodia Custody. So any crypto custody business goes that way. We are very interested in digital assets, the benefits that could bring to the whole life cycle of managing an asset, and to our business in particular. And now that I won't sort of ruin where we're going to, but also the extended products that we can offer off the back of digitizing a traditional asset, tokenizing a traditional asset.
Looking forward to getting into that later on in the agenda. Carl, finally.
Thanks, James. Afternoon, everyone. So like James mentioned, I'm one of the partners at Valentia Partners. Interest in digital assets, probably a little bit of a combination actually of what all the guys previously have said. So our background and my own background at Valentia is very much in the traditional finance, innovation, transformation, strategy space. I lead the fintech consulting practice at Valentia. So more recently, we've started to work initially, I guess, with firms on the crypto side, in terms of quite closely linked to what Ian was saying around the operationalization of what's required to become a regulated institution, both in Europe and the UK. So helping them build out their operating model to support a regulated business, and then continuing to do that work both on the e-money and virtual asset service provider side of the business, as well as starting to look towards the regulatory change that's coming down the pipeline. So be it MiCA across Europe, as well as new crypto regulations in the UK. But then there's another side to that in terms of the existing traditional finance clients that we have at Valentia and supporting them on their strategic direction, how they innovate, how they become more efficient, save cost, etc. And obviously digital assets and digital ledger technology is a big component of that. So trying to bridge the gap between the crypto native and the new world and what our traditional finance clients are doing and supporting them on that transformation journey. So yeah, looking forward to the conversation.
Thank you, Carl, and thank you, panel. Hilariously, the fire alarm is going off where I am, so I'm going to disappear just briefly after I ask this question and hopefully pop back up in a second. The first thing I wanted to get into and wanted to open up to the panel is the question of what are digital assets, and I've touched on this already. I hope the fire alarm's not coming through too loud on the mic here. So with that question in mind, then, there seems to be a lot of confusion between digital assets, crypto, and DLT, the technology that underpins all of it. I wonder, John, can you kick us off on talking through that distinction between those three technologies and asset classes, respectively?
James, it's a funny question because I think I told you a story there when I was home at Christmas. I don't know if you guys find the same thing that when I go home at Christmas, my parents are always curious of what you do for a living, and it's exceptionally difficult to explain it to them. So I started explaining to them last year Bitcoin and Ethereum basically, and why was this thing. So my point with Bitcoin is, when I was a kid, my favorite movie series was James Bond. I used to watch it with my granddad in the good room. My grandmother used to send us in there because she disliked James Bond immensely because she thought it was male wish fulfillment. A very wise woman. But my favorite James Bond movie was Goldfinger. Loved the movie. Didn't understand the plot, but loved the movie as an 8-year-old. Because I remember asking my granddad, why did people dig this metal up out of the ground, to take it out of the ground, to build a Fort Knox and put it under the ground and have the army guard it? Why was it this metal and not that metal? Why was it this versus that? And then the whole plot of the movie of letting off a nuclear bomb in Fort Knox, that was going to crash the world economy. I didn't get it. And I didn't quite understand it. But gold has been attributed as a store of value. And I don't believe in gold. I guess I have no jewelry to this day, and I never understood it as an 8-year-old, and I don't understand it now as an adult. But I do know it's an asset class, and I do know you can buy it, and I do know people put value in it, and I do know you can trade it. Now, whether I believe in gold or not, it exists, and it's an asset class. So whether somebody believes in Bitcoin or not, it exists in an asset class, and I can tell you the value by looking up on my phone now, and I can buy it, and I can trade it, and I can go anywhere in the world. And that's how I try to explain Bitcoin as a store of value. When we come on to Ethereum, they were talking about, crypto as a technology. And the example I gave around the dinner table is I pointed at the turkey in the middle of the table and I said, imagine this is the world computer. And all of us are providing the power to this world computer. And somebody wants to use the world computer. So they use top of the turkey, they use the world computer, but they pay fees for it. And because they pay fees to use the world computer, and because all of us maintain it, we get a portion of those fees. That's Ethereum. It's a proof of stake network. So we maintain the network and we get fees for that. And that was the analogy how I explained it. And we're talking about asset classes, and my point on Ethereum, and I've always kind of said this, if you believe in Ethereum as being the blockchain that people will use, then it's the most institutional product I've ever seen. It's deflationary and it gives you a yield between 4 and 8%. Pension funds will kill for that. And equally, there's other blockchains that people want to use, but it's the same principle. Now, that's how I explained it to my 67-year-old mom and my 68-year-old dad, and that's how I explained it. Bitcoin and Ethereum and proof of stake.
And to the rest of the panel, have those same distinctions proved useful to you guys when thinking about crypto versus blockchain versus DLT?
Well, looking forward to the Christmas table conversations already this year, John, but might be carrying that analogy forward. Like I think from my standpoint, James, and for the purpose of this conversation, but more generally, I think it's very important to make the distinction between crypto and what is tokenization of a traditional asset, because I think people probably conflate the two, and that has led to probably a large amount of skepticism around DLT and tokenization of traditional assets, which are remain the traditional asset classes that they've always been, whereas DLT and tokenization is purely a mechanism to trade them in a different way, provide maybe more liquidity on what have traditionally been illiquid assets. So I do think it's important to draw that distinction, but equally back to the point that John has made, there's where people maybe don't see an underlying asset in some of the cryptos that are out there, that's absolutely true, probably in terms of some of them, but other cryptos, the underlying asset is the actual technology itself, and where the use cases of that technology will then be applied back into traditional finance and into into other industries. And, you know, to John's point, if Ethereum does become the blockchain of choice for a lot of those use cases and applications, then obviously, yeah, there's huge value, huge underlying value there.
Yeah, Sean, just to sort of follow on from that, I think that distinction and that understanding is a lot clearer now than it's ever been. I think a lot of our time has been spent with the regulator, with our management group, with our colleagues and industry partners as well, really trying to reiterate the fact that separate the technology from the cryptocurrency, separate the tokenization from crypto, and really understand that. I think to the point there, it gets muddier when you start to mention the use of Ethereum, and I know we operate is sort of in the private versions of that network. But once you start going into the detail, yeah, again, there is some sort of overlap and some misunderstanding there. But ultimately, yeah, I feel, and Ian, I'll be interested to get your view from the legal and reg perspective, but I definitely feel that distinction's a lot better understood now than it's ever been.
Yeah, I would definitely agree with that, Sean. And I think what's helping here is that, you know, regulators have finally done the thinking required to draw, you know, conceptual frameworks in terms of what to categorize different types of crypto assets, to differentiate blockchains from assets, etc. You know, we now have in the last year or so, you know, written down definitions of, you know, what's a stable coin versus just a traditional crypto asset. We also distinguish between, say, utility tokens and non-fungible tokens, and you know, now that there's clarity around what those terms actually mean, it'll just make it a lot easier for everyone in the industry to communicate what they're talking about, what their plans are, and have discussion around what should and should not be inside the regulatory perimeter.
And Ian, I know when we were preparing for this webinar, we had a conversation around MiCA, and your comments were that it's funny that those organizations that can most easily get approved under MiCA are probably the organizations least likely to want to, and that centers around the liquidity required to hold crypto assets on a traditional finance balance sheet. I think there is some skepticism around digital assets in the incumbent financial services industry. Do you think that's being driven by practical considerations like that liquidity one, or do you think some of that is around the hype around FTX, around some of those high profile scandals? There's no other word for it that we've seen.
Yeah, like, it's a really good question. I suppose, yeah, the point I was saying to James when we were discussing, just to give everyone context, was, you know, MiCA, the new framework which kicks in at the end of next year, the kinds of TradFi firms that can easily do all the activities contemplated by MiCA are credit institutions, which are banks, okay? But if you read the direction of travel that, you know, global banking regulators are going down in terms of the capital requirements that would attach to banks if they hold digital asset positions, those capital rules could make it, you know, not worthwhile for any credit institution to really get into this space. So on the one hand, we've got a framework which is going to make it very easy for banks to do crypto asset activity. But on the other hand, the capital rules might make the business decide actually we don't want to do it. So then the question is, who is going to do it? And I suppose where we see the opportunities there are for, you know, say, investment services firms or asset managers, and some of the colleagues here today can probably give their perspective on this. But you know, things like doing custody of digital assets is going to be very relevant. I think that's going to be a big growth area. And then, you know, if you're doing, say, exchanges, and you know, there's also been retail exchanges, and but it also increasingly we're starting to see the emergence of institutional focused custodians and exchanges as well. And I suppose that suggests to me that, you know, if the big institutional players are starting to get into this, interested in this space, it means that, you know, the industry is starting to pass muster in terms of credibility, and these firms are smart. They wouldn't be doing it unless they thought there was a good way to make some money out of it too. So, you know, it's just interesting to see if banks are off the pitch, that might leave the opportunity in the marketplace open for a lot of other actors. But happy to hear what others on the panel think too.
Yeah, again, I mean, I think in terms of the question, James, around skepticism, we've probably touched on a number of the background causes for that, and a lot of which I think are kind of actively changing or being addressed. So I think one, the regulatory framework and regulatory environment hasn't been established. It certainly hasn't been consistent. So if you take the EU, the MiCA regulation that Ian's been speaking about, when that comes into play next year, it standardizes regulation across the EU. It's very fragmented at the moment. You've got other regulators who are moving in that direction. So the FCA in the UK, the likes of some of the US regulators obviously have taken a much more hardline stance when it comes to crypto particularly, but the establishment and formalization of regulation, as that grows over time, that will obviously give both institutions as well as retail consumers and the man on the street more confidence in crypto, digital assets, whatever you want to call it, in terms of the oversight and the robustness of that industry, particularly given it's the same regulators in lots of instances that are already regulating banks and other financial institutions that people engage with on a daily basis. I think lack of education maybe has been a barrier, and again, I think Sean pointed to earlier the fact that the delineation between what's crypto and what is the tokenization of a traditional asset, that's now clearer than it has been. But again, when people conflate the two, and then you see the scandals that you pointed to, like FTX and others in the crypto space, that naturally raises, I think, skepticism of particularly retail consumers getting into the industry. And I think the crypto winter, as it's referred to, that we've had over the last 18 to 24 months has been indicative of that, and then that in itself has resulted in probably less people than would have been expected from a retail standpoint coming into the industry. And again, the natural laws of supply and demand will dictate if retail consumers want exposure to it, that's going to raise interest from wealth managers, asset managers, etc., to move into the space. So I think we're seeing a lot of those indicators now change slightly with regulation, institutions getting more involved in the space. Obviously, you've got some high profile movements such as the BlackRock Bitcoin ETF that's in progress in the US at the moment. So there's lots of indicators, I think, out there that would suggest we're probably getting more towards that tipping point and moving beyond the skepticism that's been there up to now.
Yeah, I think it's worth sort of considering as well that the balance sheet impact is definitely a factor you have to consider, but it's not the only factor. And the other angle as well, coming from the position where we're looking at how this benefits our business in the traditional asset space, these regulations will evolve as well, right? There's some contradictions within MiCA around asset classes that fall outside of traditional regulation, but then later on it comments on digital representations of assets. So there's some contradictions there that need to be overcome. Even the accounting bulletin is already being challenged in the US. So that's looking like that's not fit for purpose. I think I'd kind of take the other stance. I know there's some negative reactions to regulation, but I think it's really positive that they're getting something out there and they are moving forward and they are taking feedback. And then that will, without doubt, that will evolve, because let's be honest, the regulators want the big trusted institutions involved in this space. Yeah, and John, you see that firsthand, right, with the institutional custody.
100%, Sean. I mean, and all we do is deal with institutions. So there's a lot of what was said there I agree with. There's some that I'm not so sure. I don't think the banks are off the pitch. Standard Chartered, Northern Trust on a call,
yeah.
and very public call on this, and we deal with all the banks, and all the banks are in this space. They're all interested. They're all moving on from proof of concept to doing actual activity in the space. I think FTX call broadly has been discredited. I remember speaking when it happened last year at the Irish Funds Conference, and I said it was going to prove the greatest fraud that we've ever seen. He's basically taken every single fraud we've ever had, from WorldCom to Tyco to Lincoln Savings and Loan to MF Global to Lehman to Madoff. He literally packaged up everything and did it in one entity out of the Bahamas. And the irony with FTX is, this time last year, or slightly before this time last year, we had a load of clients coming to us wanting to trade with FTX. So we custody assets. If our clients want to trade with an exchange, we have to onboard them. We couldn't onboard FTX. We tried 3 times. I had my BD guys coming to me. We have business. Their bonuses depended on it getting this on, and they were really keen to get FTX. And I had my compliance and onboarding guys going, this is nonsense. And we tried 3 times, and we don't have what I would consider, anything massively special on our onboarding AML KYC piece. It's standard that, many firms on this call would have. It was just, we couldn't do it. We couldn't do it with some. So I think FTX has moved on. I think the case that's come out, people have seen it for what it is. I do agree with the regulatory environment that they call. I think regulation is, and we're playing for regulation. We've been built for regulation, and regulatory clarity is key. For me, there's 3 things that need to happen to fully bring the institutions in. First is appropriate infrastructure. So we don't quite have that at the moment, but we're getting there. So you have a standalone custodian like ourselves, you have exchanges that are regulated, you have the banks involved, so you have infrastructure there. We have in the industry, people are doing conflicting roles. We don't believe, I certainly don't believe you can be an exchange, a custodian, a prime broker, and a market maker. We've learned from 200 years of traditional finance why we don't have this. Crypto is learning in a super quick time period, to be fair, but it's not quite there yet. So the infrastructure when an institution comes in is not necessarily recognizable, but it's getting there. Regulation is coming. MiCA is massively positive. And equally, if you look at our expansion, we've got the UK, Europe, Japan, Dubai, Hong Kong, Singapore, Australia, all to the right of Europe. We haven't gone on the left. If we were asking this time last year, I would have said 100% we would have been opening up in the US in 2023. There just isn't a political or regulatory clarity there, but the US will get there. It's the largest capital market in the world. It has been forever. We think in the next 12 to 18 months that will resolve itself, and in the US we'll come to that. The third thing we need outside of regulation is familiar product, and that's coming too. So the ETF that we spoke about, we have ETPs here. We will have a regulated fund in Europe in Q1 this year. So up to now, all of crypto has generally been offshore. If someone is running funds, it's a Cayman, a BVI, Cyprus, Malta, Gibraltar, Channel Islands. So once it starts moving onshore, once you have regulation, you have familiar product, and you have appropriate infrastructure, that's investable. When we speak to clients and we speak to investors, everybody is comfortable with the investment risk. They realize sometimes it's a volatile asset class. It can drop 60%, but it can go up 20x. The issue that people have when they're looking at allocating cash is operational risk. Losing your keys, getting hacked, AML issues, regulator issues. That's where allocators, lose jobs, not for a small allocation towards crypto.
And I think just back on the regulatory point, John, and probably everyone here is,
Thanks, John. I think that's really interesting. And
I think there's a slight delay there, James.
go ahead, Carl. Sorry.
No, I was just going to add on the regulatory point. I think that John was making was, everybody here, particularly those in traditional financial institutions, and even those in the crypto native space, the real, I think the players that will be there in the future, they're the ones who want regulation. And realistically, the ones who don't want regulation, probably the FTXs of the world anyway, you have to kind of question why that would be the case. So I think the entire industry, be it traditional finance and tokenization of assets or crypto native, is moving in that direction, and you know, the ones that probably won't be around for too long.
The tokenization call, I'm just conscious James is frozen, but the tokenization piece for me is super interesting. When I got into crypto 2016, I thought tokenization was going to take over the world and everything would be tokenized, and that's what I thought would happen. It hasn't happened. It hasn't happened because, you know, legal issues. Not, you know, we'll have more on this. You know, not legal clarity about the asset class, regulation, but also an element of incumbents not wanting to necessarily move. Now, what I will say is I've heard more about tokenization in the last 7 months than I have in the last 7 years. It's come back with a bomb, and everyone is looking at it now. Everyone has projects in the space, and it becomes, if we think about, say, asset management, for example, where we have three-way reconciliations between, you know, the manager, the administrator, the custodian. What if we have one version of the truth that we all agree on? You know, what does that do for a business and do for an industry? And I always remember the Bill Gates adage about, you know, we overestimate how much technology will do for us in 2 years, but we underestimate in 10. We're 7 years on from when tokenization first appeared, and we're 3 years on. So where the next 3 years takes us is going to be super interesting, and I think that's going to transform a lot of firms on this. From a tokenization perspective, if anyone doesn't believe tokenization works, it has. It has been proven in 2 cases. One was the ICO boom in 2017. Now, there may have been legality or not about securities. And again, I'll bow to the lawyer on the call. But where tokenization has absolutely 100% worked is stablecoins. And I think people don't quite realize the impact of stablecoins is going to have on business. Particularly as the FCA and other regulators are coming out, putting frameworks in place. What does that do to corporate treasuries, global corporate treasuries? You know, how much friction does that take out of the system? What the impact does it have globally? Because the rise of stablecoins has often been in jurisdictions that experience high inflation. So I remember being at a meeting in the US last year, and we were talking about this, and I said, look, it's all right for us. You know, we're all in, you know, first world countries with relatively stable governments and relatively low inflation. But what if your earning power is eroded 97% like inflation in Argentina? Or what if you're in Turkey and Erdogan can take your cash off you like that? Then surely stablecoins and having something on a ledger or a wallet makes a hell of a lot more sense. And I think that's driven it. And I think the impact where it has been in those jurisdictions, I think it's going to have a massive impact in the first world over the next couple of years.
Really interesting stuff. Just jumping back to the operational efficiency point, and one of the questions we wanted to get into is how are TradFi businesses engaging with these technologies? Sean, I know that when we caught up earlier this week, you made the point that a lot of organizations have been dabbling in DLT, and it's sort of coming time to make some bigger bets and to really show some benefit from the technologies in that operational space in terms of greasing the processes and making things flow more effectively, more cheaply, and increasing trust. Do you mind going into that a little bit and what you've seen in that regard?
Yeah, sure. And I think it follows on really well from John's point, right? I think that the 7-year period up to this point has been very much experimenting. And I don't mean to sort of use the term flippantly, but kind of doing it for the sake of doing it, you know, being able to put to press that we've tokenized something. I was at a conference yesterday, and even the start of that conference was very much focused on sort of the issuance piece. And, you know, 100 people touch the issuance of a bond. Traditionally, if you tokenize and issue it digitally, then you only need, I don't know, 10 people to do it. But that's not where the value is. The value is downstream. The value is beyond issuance. The value is the additional products you can provide if you're tokenizing something that you can't use for collateral today, like a money market fund, which again, BlackRock and the like are leading in that space. The value for an organization like JP Morgan, that size, with internal cash transfers with their JPM coin. You've seen what HSBC are doing with gold. I mean, so I think that 7 years up to this point has been very much marketing, very much exploring, experimenting. I think the next 3 are going to be genuine use cases, and the narrative's definitely changed over the last 12 months with the organizations we speak to and work with, in that it's not, the interest isn't anymore in, oh, you've tokenized something. The interest is why. What does it mean to me? What does it change for my business, my margin, my efficiency, my risk reporting, and so on? And as a custodian, we're downstream to that issuance, and we have so many sort of connection points to either enter the business when we look at the asset life cycle that we manage, and that's really where our focus is now. It's on, what does this mean to us from an operational efficiency? What does this mean to our clients, and how their expectations changing as a result of this? And then also, what other product opportunities are there off the back of this? And it fits in perfectly to what John said. And I think the next 3 years, you're going to see real material changes. And as soon as people realise those benefits, you'll get mass adoption. It would kick off rapidly.
There was a really super paper released by Deloitte in Luxembourg in 2016, and it was, I can't remember, the executive summary was basically about how DLT and blockchain was going to completely disintermediate the fund and the funds distribution industry in Luxembourg. And it would be a paper that maybe Sir Humphrey would have called brave. But it's excellent. It really is. And even for something written now, 7 years ago, it's actually worth a Google. It's still up there. You can find it. But I ran into one of the Deloitte guys a couple of years ago in Lux, and I mentioned the paper, and he said, "Oh, I was involved in the writing of that." And I remember asking him, I said, "How did you get that printed?" You basically told every client you had that their businesses were gone. But it was such a prescient, really well written paper that now is starting, to Sean's point, starting to have that effect. And certainly when I started on the tokenization first, my partner picked up, every time we met someone, they talked about the tokenization of the St. Regis Aspen Hotel. And we got to the station, and I'm getting nods from Sean. We got to the station, he picked it up before I did, and he said, "I want you to mention tokenization to me without mentioning the words St. Regis Aspen." And then everyone shut up. And that was it. But it's certainly, we're seeing it so much now, from gold to bonds, to everyone. Everyone is looking at it, and there are real world cases at this.
Yeah, and I think what's interesting as well is, as we now have a regulatory framework for these business models, particularly like, say, custody of digital assets, regulators are going to be looking with a fine-tooth comb through the operational risks associated with that. And because up until now, a lot of times, it's been like just through an AML lens or through other lenses that they've looked at business models. And I think, where you say are an established custodian in the TradFi sector, you will have developed like well-oiled processes, procedures, controls that maybe new entrants to the sector who have just up until now existed in an unregulated environment haven't had to develop or mature to the same degree. So, I think in a way, the regulator's perception will be, same risks, so same rules, and then maybe also, insofar as possible, the same operational controls that you can apply to this asset class where possible to do so. I just think that's going to be the kind of conversation a lot of firms are going to have with their regulator in the not so distant future.
Really interesting.
Sorry, James, just to add, I mean, the other big use case John mentioned, stablecoins. Clearly all of the central banks globally are standing up and taking notice as well, because you've probably got 100+ central bank digital currency pilots, proof of concepts, etc., underway globally. And obviously the EU and other regulators look to shut down the Facebook Diem project a number of years ago, based on the impact that was potentially going to have on the financial system. So again, it's just another indicator of the kind of the tipping point maybe within that 10-year cycle that John spoke about, around the number of use cases and the level of experimentation, or moving from experimentation maybe into real world use cases that's going on now globally.
Thank you all. And this segues us beautifully into the final question. I do just want to remind the audience that that Q&A functionality is there, and we will be going over to Q&A shortly. So get your questions for the panel in now. So we've talked a lot about the state of play now. We've talked a little bit about the history of digital assets and how we've come to where we are. We're talking about being partway through a 10-year cycle that is going to lead to massive change in the industry. I heard the adage yesterday that when light bulbs were invented, candle makers didn't like it very much. So my question to the panel is, do we see a wave of disruption coming off the back of this technology? And if so, would you like to place some bets on who will be the winners and who the losers in that disruptive environment?
I think I definitely have to be a bit careful here, but I think part of my role in the innovation group for so long is, it sounds a bit cheesy, right? But it's to disrupt our organisation from the inside in advance of being disrupted externally. So I'm quite used to the conversation of speaking to business leaders and managers and saying, look, this is how your business is going to look in the future. You need to rethink what your USP is, right? What services you're selling, and luckily we've got a real good understanding across the management group in the organisation that if a piece of technology can take away our client, then we're not providing value that we should be providing, right? We can provide a service beyond that. So I think that's key, and I think we've had a few exercises where we've looked at what custody of digital assets will look like in the future on a whiteboard. And the disintermediation is massive, it's huge. I mean, those responsibilities still have to exist and those roles still have to exist in some form or fashion. But with regards to those being individual big centralized entities, it doesn't look like that in the future. I mean, how long it would take us to get there, how protective and political each of those areas get over their future, who knows, right? I'm sure we're all long in the tooth in this space. As for those that survive, look, it'd be those that can adapt, those that can change their business model, and those that can still be adding value.
I think I agree with Sean on that. Predicting the future in digital assets is it's a hell of a job to try and do. You know, and if I take it in the context, we didn't have, say, for example, DeFi 3 years ago. We didn't have proof of stake. And these are all, so what's the next thing that's going to happen in this technology? Predicting 3 years, you know, we try and do planning and we'll do our 5-year plans, but you know, sometimes, you know, even planning a year or 2 years ahead in this space is exceptionally difficult. Now I hope it comes across. I love my job and I love what I do, and the industry is great and it's quite exciting. But to try and predict the future at times is very difficult. Will it be disruptive? It's happening at the moment. It's happening now. It's happening now. And to Sean's point, it's those who adapt will survive.
I think as well, James, I mean, it's quite linked into this, and particularly when you think about what governments, central banks, financial institutions are doing, and applications of blockchain technology or digital ledger technology. I think the big one, and it's been spoken about for a long time, but it certainly hasn't been cracked, is like digital identity and how because I think how consumers, institutions, etc., engage and making their daily lives more efficient, operational efficiency, etc. If you can crack how a single person's digital identity is reusable across government agencies, across financial institutions using blockchain technology, there's massive opportunity there, and would kind of feed into everything we've been discussing here as well around AML, KYC, and just giving more confidence in the industry as a whole, and kind of knowing who you're transacting with. Now, obviously, that goes against a lot of the DeFi side of the house, but again, if we're talking regulated financial services here, I think that's going to be a really big development over the next few years.
Yeah, and I think as well, just the advent of all these rules are going to force firms to decide, like, if I've been doing a little bit of everything up until now, like, what am I going to specialize in? What's my niche going to be? Leaving aside those, you know, conflicts of interest issues and consumer protection concerns, you know, it's just going to be the case that there's going to be, you know, the idea of firms just doing a little bit of everything. I just don't think that's going to last, and that's going to, you know, drive more innovation and perhaps exciting new products as well.
Really, really fascinating question. I think digital identity is going to be an area that really, I mean, it's going to change the world, isn't it? Not just our industry. Fab. So we've reached that time for Q&A. I'm sure the panelists are quaking at your questions. But if anyone else is sitting on any, then please do get them in. I'm going to start with the first one that came in, and I think we're looking for some specifics. So, what operational processes have you seen within traditional finance benefiting most from blockchain technology already, and where do you think the biggest untapped opportunities are for the future?
I mean, just from, I guess, in my previous life as a in banking, certainly, in Australia, probably one of the things I've seen is around the likes of trade finance, where you know, massively manual documentation based. So moving kind of trade finance flows and deals and having that single source of truth from paper-based onto, again, very much in a proof of concept environment rather than necessarily in a repeatable use case, but massive operational efficiency from, particularly from those kind of documentation heavy manual finance flows that we see in lots of areas globally. That would be one from my standpoint.
Carl, I think the point on the one version of the truth is the piece. I mean, if you look at so many industries, we spend so much time reconciling each other's versions and then working on the breaks and then working the breaks, and we're doing it repeatedly. What happens if we agree on one version of the truth? What does everybody do? What do the auditors do? How do you audit something now if everyone agrees what the truth is? So it has the potential to be seriously disruptive.
Yeah, and to John's point as well, if that version of the truth is created and governed by smart contracts where you've got that immutable record on chain, then again, that just makes audit so much simpler. So I think that's really, yeah, the use of that single source of truth, the use of the utilization of smart contracts to govern behavior, actions, tasks, and so on. Yeah, that's really, from an operational perspective, that's and obviously you've got to access that source of truth, but yeah, that's where the benefit lies, the main benefit for us.
Thank you, panel. This question follows on from that, I think, and Ian, I think this one will bring you in. So how do regulators ever get themselves comfortable with permissionless chains becoming part of the critical FMI architecture? The scale and use of DLT interoperability would appear to be the biggest challenge. How likely is it that a system-wide blueprint against which all firms, including TradFi firms, work towards in addressing this challenge?
Yeah, it's a really good question. I think the regulators are going to have to go on a journey, and it's going to be up to firms to, you know, really prove that the concept works in terms of, you know, is the single source of truth actually accurate and verifiable, you know, and yeah, and typically the regulator would say, oh well, is there an audit trail, can it be audited, etc. But if we're dispensing with those concepts, you know, like what's the, you know, what gives people the confidence and the trust in those systems, you know? So you know, I don't think it's just going to be regulators that need to get their trust levels up. I think it's going to be all the participants in the transaction or the chain concerns. So you know, everyone's going to have to learn to place trust in this technology, and whether or not it'll get there remains to be seen. But obviously that's what we're all striving towards, it seems, here in this industry right now, you know.
Yeah, and I think one of the answers, James, was kind of in the question, right? I think the only way that's going to happen is through collaboration. I think we've been, I mean, Ian, you probably see this a lot, right? We've got sort of partner institutions that we work together with to approach regulators together with a joined up story, so that we can try and ensure the correct outcomes with our engagement. And I think as well, even with industry partners, I think that's the only way this will move forward. It can't in isolation. It has to be that collaborative effort.
Yeah, and I guess maybe also what also needs to, you know, we talk about like new rules coming down to regulate actors and conduct and so on. You know, probably the other part of the law that needs to catch up here is, you know, like around, you know, what happens when there's disputes or insolvencies. You know, will the courts recognize, you know, the smart contract as the source of truth and so on. You know, so we're gonna have to go through that pain of having the first ever disputes over these kind of technologies and having precedents set, and that in turn will probably help market participants get confidence in because they know, well, actually, if we use this, you know, we know ultimately if it gets disputed, you know, someone independent of us will actually uphold that interpretation of what was agreed in the single source of truth. So, you know, there's still a lot of maturity required in the legal world in those areas, and that's broadening just beyond financial services law into just, you know, general litigation, contract law, insolvency principles, etc. So it's very varied.
I'm going to twist Hannah Jane's question slightly here to build on that. So Hannah Jane asks about collaborations between traditional banks, TradFi institutions, and crypto native blockchain organizations that are more emergent in the space. The question is, what are the roles of those different organizations in those partnerships, and can we learn from any successful partnerships that are already ongoing or have delivered to date?
I think one thing, and interested to hear maybe John and Sean's input on this. Certainly, like one thing we've seen growing massively, I think, in the last few years is kind of the concept of banking as a service, where you've got your fintech firms bringing modern technology to bear, from kind of end-to-end digital core banking stacks through to specific components of the banking stack, to make traditional finance operations more efficient, effective, etc. I think we're starting to see some of that in the digital assets and blockchain space as well, where you've got crypto native firms potentially utilizing their technology either from a trading exchange or custody capability, and actually bringing that to into the TradFi space to bring that technology, so that, you know, when firms are making that kind of build or buy decision, that, you know, there's ready-made partnerships there. So I think that's a relatively established model, and I think a lot of the TradFi firms now have probably recognized over the last 5 or so years that actually fintech doesn't necessarily need to be a competitor, that, you know, you can collaborate and partner with fintechs to make your own business models much more effective. And you know, I think the digital asset crypto space is no different.
I think what I'm starting to observe, particularly in the last number of years, is the amount of people who've come from a traditional finance background who are now in the crypto space, and that's brought a level of maturity that possibly wasn't there before. I would have characterized the early days of say cryptos. There was 2 tribes, and there's a very much crypto native tribe, and there's very much a traditional finance tribe, and they literally speak a different language and they think differently. But there's been a merger of those 2 tribes, and they've started to infect each other, and they're getting learnings from each other. And it's starting to mature. And I'll give an example. This week we had a call with a well-known foundation this week to discuss, you know, we custody their assets and provide staking for their clients. So we do custody, but we can provide the staking services, and the assets stay with us. And the conversation we had with the chap was, okay, we can do this, but we will go to the FCA and we will go to the CBI to notify them and get permission. Now, if we said that 2 years ago, they would have rolled their eyes and gone, what are you doing talking to regulators? Whereas this guy goes, absolutely, this is brilliant for us. We need you to go to the FCA. And we've already been through this process with other protocols. But the reaction, and we were really talking about it this morning, the change and the maturity that's starting to come, and that collaboration and that cross-sharing of knowledge is happening.
I think regulation's been the primary driver for that, John, because firms, particularly some of the again, taking the crypto native firms, if they've moved from the US into where they would view themselves probably more as tech firms than necessarily financial institutions, but as they've come into the UK and Europe, they've realized the regulatory environment's a little bit different over this side of the world, and you need strong risk, compliance, governance structures, op models, and so on in place, and actually it's forced them to go and bring in that expertise from traditional finance, and you know, that's only going to that burden is only going to increase when you look at MiCA, you look at what's happening with the FCA in the UK, and even there's been with consumer duty, UK travel rule, financial promotions now that view crypto as restricted mass market investments. There's just a flood of regulation that's coming through that means they've kind of had to go down that road. But equally, yeah, you're seeing much more of a crossover between the two now, I think.
And with one eye on the clock, building on that question from Cara here, for this sector, it would seem there is a wall of institutional investment waiting to get involved, but the regulatory risk is proving too burdensome. In your opinion, in Ireland or Europe, is there an appropriate level of public-private collaboration to evolve the regulatory framework and build confidence for industry participants to consider moving in towards tokenization? Conscious of time, maybe 2 minutes on this one if we can.
I'm going to completely pass this across to Ian, because I would never suggest that I have a greater knowledge than Cara Hennessy has on regulatory matters.
Yeah, it's a great question, Cara. My tuppence is that, you know, ultimately regulators just enforce laws that are made by politicians. You know, and what was interesting was that, you know, this was quite a heavily negotiated EU law, the MiCA law, that has just been passed by the EU and it takes effect next year. What's really interesting about the MiCA is it was consciously aware of the things that it wasn't even talking about. So, for example, it doesn't talk about lending of crypto assets. It doesn't really get into staking or anything like that. You know, there's a lot of areas where it's quite silent on. It also, unlike say MiFID, doesn't talk about like distinguishing between say retail investor protections and institutional investor protections. So they're all areas that are going to be up for grabs. And there is a sunset provision in MiCA which requires the EU to look fresh at some of these topics very quickly in the next couple of years. And I think they're going to be all the policy issues that industry participants, citizens, politicians in general will be able to feed into and shape the next iteration. So it's really just this is just the jumping off point for regulation. And I think there will doubtless be more refinements of that in the years to come.
Ian, thank you for that. I am conscious of time, so going to wrap up there. Thank you all for your time on the panel. Thank you for engaging so actively with the questions and making this such a productive conversation. Ian, John, Sean, Carl, thank you so much. Thank you also to the audience and for all of your questions. It's made for a really interesting conversation. By way of wrap up, we'll be making this webinar available online in due course and sending out a link to all those who have attended or signed up to attend if they were unable to make it. If you'd like to forward this on to any colleagues or contacts, please feel free. If you want to learn more about digital assets in general, then please go to valentiapartners.com/ourinsights, where you'll find all of the research content from our latest digital assets campaign. We'll shortly be adding the final article to that, exploring digital assets and their impact on the industry. If you'd like to learn more about how Valentia Partners can support both incumbent and emerging organizations within digital asset strategy, technology, and regulatory approvals, then please reach out to myself or Carl Houlihan. We can help your organization too. All that remains to say is a big thank you to the Valentia Partners team who've made today possible, and wish you all a very good day. See you all next time for our next live event. Thanks again to the panelists.
Thanks, James.
Thanks all.
Thanks, James.
Thanks. Bye-bye.